Good afternoon, everybody. Welcome to the Trader Merlin Show. It is your Tuesday afternoon. As you guys may have seen, I was making some mistakes when I was posting for the show earlier today. I'm not sure how that happened or what mistakes I was making. For some reason, I just blanked out. And I don't know how I could blank out that I had such an extraordinary guest on the program today. We've been trying to get him on for some time, and it's up just my lack of communication skills, which my therapist and I are working on. But we're getting to that point where I'm going to try to bring this gentleman on more and more and more because of his skill set, of what he brings to the table, of just the quality of character that the individual is. And I am talking about Mr. Scott McCormick, CMT from Trading Academy. There he is, the man, the myth. He's on camera today, folks. That is how special today is. How you doing, Scott?
Any better than I couldn't stand it.
Any better, he couldn't stand it. I'm noticing the Golden Gate Bridge there. What's going on? You're in my old stomping grounds. I know you're not in NorCal.
It's your neck of the woods. And, you know, if they had like an Old West kind of theme on this, I would have used that instead. But, you know, I figured, why not?
I like it. Well, you know, you can make whatever kind of background you want with AI. Just let me know. I will have animated video of you if you want behind the scenes.
How about a smoker in the background with a cow or something?
A smoker with a cow. You know you can't ask these things of me because I will deliver a smoker and a cow animated behind you.
There you go.
We'll make it happen.
Yet, a cow smoking. A cow smoking a chicken to kind of go with the whole Chick-fil-A thing.
Just so those who don't know, Scott loves smoking meats. He should have his own like meat smoking channel. That's how good he is. Although I've yet to sample the goods. I always hear about how great it is.
Yeah, you're welcome out here anytime.
All right, looking forward to it. You know, last time we had you on was literally the first week of the year as we dove into what was happening for 2025. I'll just start off high level. Like, has this year gone as you have expected, or have there been some curveballs along the way?
Well, how political do you want to get?
Hey, you know what? The only thing about politics is I just try not to like hate on a political party. We can all say if it's a fact about a party, go for it, but don't disparage anybody.
So okay. Let's keep it technical.
Okay,
right?
Perfect.
So the measure move targets that I had for the S&P 500, which basically went back to the market lows back in 2022, 2023, those were achieved in the first part of the year.
Wow. Okay.
Like in and around December and the first couple of weeks there in January, the target. And when I say the target on the S&P 500, and for those that maybe aren't familiar with me or you know my antics and my tactics, I like to use the S&P 500 cash index for my overall measure, and then of course I'll look at the Russell 2000.
I'm changing I'm driving for you because as you speak, I'm adding on the SPX. So there we go. SPX is up on my side. You're always welcome to share your screen too if you like.
Oh, okay. Yeah, if you saw my screen right now, it's over animated. So anyway, the target that I had on the S&P was in and around 61.18, and we hit those numbers late December, or should say early December, and then going into February. And so it was fortuitous that we saw the correction that we did, and interestingly enough, the correction that actually unfolded there between February and the lows there in April, regardless of the factor driving that decline in ultimate recovery. Tweet.
Mm-hmm. Yeah, right. Yeah, I love that.
That's about as political as I'll get. But you know, there's nothing social or true about it. There's another pun there for you.
There you
anyway,
go. Man, you're on it today. You're fire.
So the decline that we actually saw, not percentage-wise, but point-wise, was the exact same, or nearly the exact same as the sell-off that we had back in January 22 through October 22. And so it was really interesting to kind of see that symmetry in the market. And right now, you know, we're back into an impulsive phase. I would have expected a little bit more of a correction. Probably coming back down towards the lows, where kind of right before we broke out back in 2024. So kind of back down around the 4,200 level on the S&P.
Mm-hmm.
We just didn't get there. And so far, you know, as it stands, we're actually kind of bumping up against that next measure move projection that I had in around the 64.51 area. We kind of tagged that spot close to it a couple of weeks ago when we saw that sell off in the week of July 28th. And now we're pushing back up towards that area. But what's interesting about it, and kind of keeping it in theme with the Beck report, is that as I go through and I look at the market, I'm not just looking at the cash index. I'm looking at the relative strength for each of the sectors and trying to relate that to the overall sector rotation model that was developed by Sam Stovall. And what I'm seeing is that this is a thinly driven market at this point. There are very few sectors that are actually demonstrating any type of relative strength at all. And the one, of course, is information technology. And I don't know if I've mentioned this on your platform before or not, but those that are regular attendees of the monthly market overview at Trading Academy, I frequently reference the S&P 500 and the sector breakdown because the website itself, they update that at the end of every month. And I take a look at the sector weighting because obviously the S&P 500 is not an equally weighted index. It's a market cap weighted index. Right. So the bigger the market capitalization of the company, the more influence it's going to have. Right now, Nvidia is the biggest company within the S&P 500. And information technology as a sector is, of course, the biggest sector, followed by financials, which is, when you look at, and this is as of the end of July 31st, information technology was 34% of the S&P 500. Financials is 13.8. So, you're talking about a sector that is, 2.5 times as big as the next largest sector. And the concern there, and I pointed this out in our last broadcast, which was last week, financials are starting to demonstrate relative weakness. And despite the XLK actually trading up towards all-time highs again, what we're not seeing is a breakout in the relative strength. Like we saw a recovery from the lows back in March, but we're not seeing a relative strength ratio that's above where it topped out back in June of last year. Right. So it's a pretty interesting situation because as the markets go up, you would expect, and in this case the sectors go up, you would expect to see that the relative strength kind of follows along with it. And right now it's not. It's going up. It's just not breaking out, making all-time highs like the actual sector is, the XOK. So little concerning to me because if that tops out, if that sector tops out and we see that deterioration in the relative strength, that could actually lead into our next major correction.
We talked about this on yesterday's show, just the shocking overweighting of some of these indexes, right? So you talked about the SPX and, the top 5 holdings in the SPX, which are all part of the Magnificent Seven. In the SPX, it's 20, I think we said 25.2%. In the NASDAQ, it was like I think if I remember correctly, guys, it was like 54% of the total NASDAQ 100 is just 5 companies. Yep. Now, there's always been a bias and overweighting to certain companies, but does it concern you now that we have both of these indexes so heavily dependent on the success of those 5? Because should those 5 tumble at all, it could cause, just this cascade of selling in those indexes. At least that's what I'm thinking.
Yeah, as a matter of fact, we were looking at this yesterday, and if you, and when I say we, in the stock XLT, we were going through and just taking a look at the top 10 names because every Sunday I prep for the week when I publish the daily market overview for our mastermind community, and part of that publication is the top 10 stocks for each of the 4 indexes and ranked by either market cap or price for the, in the case of the Dow Jones Industrial Average. And when you look at the S&P and the NASDAQ, the top 10 stocks, like they're identical all the way through number 8. Yeah. Right. The only difference is like the number 10 and the number 9 spot. So number 9 on the S&P was Berkshire Hathaway, whereas Tesla was number 10. And then on the NASDAQ, Tesla is number 9 and Netflix is number 10. But the fact that they're all the same up through the top 8. And when you look at the top 8, Broadcom, Apple, Microsoft, Nvidia, all IT. Yep. Right. And then Google, and Meta, XLC Communication Services, and then you've got Amazon as your consumer discretionary. So it's not a very diverse list, and to kind of take it a step further there, number 10, Tesla, also consumer discretionary.
You on which one you want? Which you on the SP or Nasdaq?
So if you don't mind, I'll go ahead and share my screen.
Yeah, sure.
Okay, so you should be able to see this. So this is the publication that I write every day for the Trading Academy, and
this is for if you're a mastermind, right?
Yeah, so this is underneath the mastermind community. You'll find that underneath the daily market overview, and I cover 11 futures markets and provide trend and zone breakdown for each of those. And then in addition to that, on a weekly basis, I go through and I update like the top high impact economic announcements. I'll update the low to medium impact reports. But then again, part of the publication is to update this on a weekly basis. So all of the data that you see in terms of price and market capitalization is as of the previous Friday's close, because again, I update this on Sundays. And so when you're looking at this, right, the S&P and the Nasdaq, these are ranked by market capitalization because they're market cap weighted indexes. Right. So in going through this, some I get the question often, why put Google in there twice? It's not me, it's the S&P and the Nasdaq basically.
Class A and Class C shares.
Yeah, exactly. So, we can make the modification and just include the one and add another stock up there. It'd be JP Morgan for the S&P. I forget who it would be for Netflix, I think, or the Nasdaq. I think it'd be Costco. But as we're looking at this list, going number 1 through number 8 there, these are all the same.
Yeah.
And so when the other thing, and kind of going back to what I was talking about a moment ago in terms of sectors, when you take a look at the S&P 500, this is how the S&P 500 is actually broken down, right? So when you look at the stocks and what sectors they're in, so if you take those top 10 stocks from the S&P and the Nasdaq, right? Microsoft, Nvidia, Apple, and who else?
Google,
there's another one,
Meta.
So Broadcom fall into the IT, Google and Meta fall into your communication services, right?
Oh, really? Okay, all right.
Yeah. And then consumer discretionary would be Amazon and Tesla. So you start to see, and my primary concern would be, well, what if Nvidia starts to top out? Right. What if Microsoft really breaks down? Like Apple, if you take a look at like what's happened here, and I'm just going to bring up a chart really quick. So this is Apple. This used to be the number 1 stock, right?
This one by itself at one point was 25% of the Nasdaq by itself.
Yeah.
Crazy.
Yeah. So and as a matter of fact, like back in the day, they actually rebalanced that because it was such an impact on the indexes, the Nasdaq in particular. So instead of it's like instead of trading Apple, you could trade the NQ, right? Or it didn't matter. They were tick for tick. But when you take a look at like what's happened here for these, this is Nvidia, right? And then, of course, here we have Microsoft, and I'll make Microsoft here in blue and green for all of the Florida Gator fans out there. Let's see. All right, so we've got blue. Did I say blue and green? I meant blue and orange.
I think you did.
Yeah. So anyway, when you take a look at this, you can see here like Nvidia and Microsoft are actually fairly
lockstep
correlated, right? And Apple until last week was basically just flat. It was having a really hard time getting above the 215 level, and then of course last week somebody got a gold trophy somewhere that I heard of, and nice little pop there because I don't know. I guess
because they got the golden ticket from Willy Wonka.
Yeah. So anyway,
which is another interesting question I have for you. I mean, obviously we see this super tight correlation as you have these magnificent 7 companies. Well, I guess you could take out Netflix. Screw Netflix, they're done, but not done, but just not part of the magnificent 7 anymore. As you look at these companies' ability to buy their way in. I was calling it pay to play yesterday, right? Where you say, oh, hey, Trump, I'll commit $100 billion to U.S. infrastructure, or Nvidia saying, hey, I'll give you $3 billion worth of our profits. It's like, or 50% of our profits in China. Does that concern you as well? Because some of these smaller players, some small semiconductor companies, some small chip maker, there's no way they're going to be able to pony up and compete with these guys. And it feels like the competitive advantage for these top players in both of those indexes, NASDAQ and S&P, will continue to be further solidified because of their paying to have preferential treatment in the tariff war. And I don't know whether that's right or what the impact will be for the markets, but I'm just curious what your take is.
I think that it's going to be studied in master's and PhD level economic courses for generations to come. That's my thought, because it's highly unethical in my opinion. There's no reason for it. To me, I understand the restrictions in terms of intellectual property and sharing that information with China. But the fact of the matter is that I should not have to pay the government to conduct my business outside of tax revenue.
It's bribery.
That's it.
I mean, it's
essentially it's full on bribery. So, it's like if you wanted to, I guess, not wake up with a horse head in your bed, you should probably kiss the ring. That's my opinion.
Well, I mean, and it's sad that we have to think that way. And from a citizen's philosophical level, you and I can both pontificate on how we both feel it's wrong. It shouldn't happen. It's not right.
Yeah.
As a trader, though, let's put our emotions and feelings aside and say,
I don't care.
I don't care, but ultimately, that tells me that we're going to continue to see Nvidia surge to the up. I mean, if you open the floodgates to China for Nvidia, I'm sure Jensen Huang's like, I only have to give you 15% of my Chinese revenue, and I get to keep the 85%. Sign me up, let's do it.
Yeah.
It leads me to believe that this train will probably keep on rolling to the upside because there's so much weight in these 5 companies that lead both indexes. And do you feel the same?
I do, and as simple as it sounds, one of my favorite quotes or tenets from Dow theory is, and I'm paraphrasing here: trends continue until they reverse.
Yeah,
and at some point there will be a catalyst. What that catalyst is, no idea. But as you're looking at a company like Nvidia right now. And I'm just going to delete these here to get rid of the overlays. But if you take a look at Nvidia,
it's just crazy.
And this is my this is generally how I approach this from a longer term perspective, right? I'm always going out to the monthly chart, just kind of flipping over to a logarithmic scale. When we take a look at the overall trend, obviously it's still up. There's no overhead resistance on this.
Nothing.
So the question that I would have would be, historically, what are the patterns in terms of percentage gains? Because in terms of point distance, like one of the things that I like to do is measure the moves, right? So we're talking about the impulse moves that we'll generally see, and I'm starting from this point as opposed to here or here, because all of this price information is below that prior high. So in going through and looking at all of the major advances that this company has made in terms of percentage change over the course of the last 20 years or so, we're talking about 1,700%, 1,500%, 4,900%. If we were to take it from these lows here, it's still 2,500%. Here you've got 1,000%. Going up to the highs here in January, it was 1,300%. What if we had like another 1,000% move from the lows here in April, right? That would put that stock, Nvidia, that would put it up at $1,000 a share from current levels.
But that'd put it like a $12 trillion market cap.
Yeah, basically.
Crazy.
I mean, you take the current market cap, multiply it by 10.
And we're at $4 trillion. Yeah, it's funny.
So it'd be a $40 trillion company.
I have a lot of people here who are holding Nvidia, and they're like, "Yes, please, yes, please."
Yeah, right. I mean that would be obviously from an investment standpoint, that'd be fantastic.
Yeah, Well, and because it's the number one weighted component, it'll bring up those indexes overall. So I mean, right now, everybody who's got a retirement account, a 401k, anything that you're holding, You got to be a fan of Nvidia. Even if you hate the company, you've got to be a fan of Nvidia.
And I think that also, so basically, like, for those that maybe are not completely clear on the implication here, if Nvidia is the top stock and it continues to go the way that it does, and when I say top stock, not just because somebody on CNBC likes it or we like it or anything like that, it is the number one company within the S&P 500 in terms of market capitalization. If Nvidia continues to go up, so is the S&P 500. I mean, if we take a look at if we just add the SPX here, let's see. All right, I like to use the CBOE because that's where the data actually comes from. But when you take a look at what's happening here, and I'm going to drop down to like a daily, weekly chart. The S&P is Nvidia right now.
Yeah, right.
Okay, so Nvidia keeps going up, S&P is going to keep going up, right? Doesn't necessarily mean like all 500 companies within the S&P 500 are going to have the same performance. A lot of them won't. So the other side of that is Nvidia starts to actually go down, breaks down, so is the S&P 500.
Right.
So for now, those invested in S&P 500 large cap ETFs or mutual funds through their 401ks or their IRAs or anything of that nature, they're fine. They're doing pretty well right now. Of course, their earnings are coming out on the 27th, but I don't see anything that would basically result in that stock actually gapping down from that area after that announcement. So,
it's interesting. I was asked at a conference a while back. It actually wasn't a conference, one of our Trading Academy things we did up in Ontario or something. It starts with a D. I can't remember it. Anyway, the audience had asked about black swan events and the theory. Were you at that one?
No.
Okay.
No.
The thing with the black swan event.
I don't get those invites.
Oh, you should. I want you at more of it. The thing with the black swan event is, we don't know about it until it happens, and it's something in hindsight you go, oh, shoot, I didn't think about that.
Right.
Here's my black swan scenario, and I'm just curious what you think. So, my black swan scenario is that China and the United States, the tensions continue to escalate. And you start to see more and more tension build because of tariffs, and Trump goes, I'm going to raise it to 100%, and then, we see China raise it to 150, and then it keeps escalating. We already have warships around Taiwan. So does China, circling Taiwan and protecting it because Taiwan says they are not Chinese and China says they are Chinese. My black swan event scenario is that China goes in and says Taiwan Semiconductor is officially a Chinese company and we're not going to export any chips to the United States from TSM. From the numbers I read, 97% of all of NVIDIA's chips are built with TSM components. Mm-hmm. At that point, if NVIDIA was to cease to get the materials to build those products, which has the most unbelievable demand for right now, NVIDIA implodes, right? And yes. That's where you could see a 50, 60, 70% drop in the price of NVIDIA, depending on how much this escalates. Or more, right, depending on how this escalates. Now, that, in my opinion, would lead us to a full-on World War III because there's just no way that Trump and current administration would sit back and just kind of let that happen. Like, we need those chips, right? That's our economy is driven by chips. Without it, we're toast. From a crazy perspective, on the crazy scale of 1 being, seems totally normal, or 10 being you're off your rocker, where would you rate that hypothesis of a black swan?
Okay.
You had to think about that one.
I used to live in the DC area, and I worked for Schwab in that area, and I had a number of clients that worked for agencies that will remain unnamed, and one in particular, he always had a game plan for the Straits of Hormuz being shut down, right? And that was in 2006, 2007. It took 18 years for that to even come close to happening this June.
Yeah.
Right. So I think everybody knows like what the chessboard looks like in that region.
Mm-hmm. Absolutely.
Right? And they have to navigate that very carefully. Interesting interview that I was listening to the other day as well. one thing that you generally don't hear of, except for in certain circles, is China and their investment in not just their military force, but their naval force.
Right. Well, we saw that crash
Apparently,
yesterday. Apparently they need get some boating lessons. They didn't do so hot yesterday.
well, no, but there here's what's interesting, right? So prior to Pearl Harbor, not to take this away from markets, but kind of tying it back to your point, prior to Pearl Harbor, the battleship was the main
Right.
ship for the U.S. And it wasn't until after that we incorporated more aircraft carriers into our fleet. Our ability at that time to actually create naval vessels was significantly higher than where it is today. And as it stands right now, China's ability to create a ship is 10 times higher than what it is for the United States.
Right. Yep.
So if we did enter into some sort of naval conflict, it's not going to go well.
Yeah.
So the point here is that I think from a diplomatic standpoint, the State Department's going to have their hands full in trying to navigate the trade tariff conversation and trying to keep things stable.
Yeah.
Because we do not want to see that escalation. China, I think, probably believes that they're holding a lot of cards, and I think this current administration thinks that they're holding a lot of cards, but in the background, they're not.
Yeah.
So we have to tiptoe very, very carefully in this situation.
Well, it gets precarious,
So-
and I know that in your experience, when you see markets that have been so long in the tooth, and honestly, this may be the longest bull market I've ever witnessed in my brief trading career of 28 years. Everything works until it doesn't. A common mantra in the markets, and right now, it seems like this market is bulletproof, impenetrable. It just keeps on going, and at some point, you know it as well as I do, that it is going to sustain a big crash. And I'm sure Oliver is here and he's going to tell me I'm the doom and gloom guy, but this is just market facts. It will at some point. I don't know when. And there could be a wide variety of different variables that cause this market to go into chaos. But, when everything seems so perfect and so rosy, that's usually when it happens.
Yeah, it's funny. I don't know how closely you followed this, but I made a joke about this in a meeting last week. But apparently they are reviewing the pattern day trader requirement for equities and actually reducing the requirement from $25,000 down to like $2,000 for a margin account in order to have day trading buying power. And I made the joke that within 6 months of that actually passing, we're probably going to see the market top. Because any time you see deregulation in the market is more often than not when we are reaching an extreme.
Yeah.
And then it's not too long thereafter. I said 6 months, but I would go so far as saying 6 to 12 months from there, you would most likely see a market top. Now going back to a comment that you just made about the longest bull market that you've experienced, and this is why I like to look at historical charts
And logarithmic. You like logarithmic, huh?
I do for longer term charts. If you're down on like a daily chart, unless there was like a significant percentage change, you have like a 60-cent stock that went to $60 within 3 days. I'll use a regular scale, a linear scale, but there's different types of bull and bear markets, right? We use those terms generally, but if you were to break it down into subcategories, you have your secular bull market and bear market, and then you have your cyclical bull and bear market. And one of the things that the last time we really experienced a secular bear market prior to the 2000s was back in this period from 1968 going in through 1980. And when we take a look at the secular bull market that actually followed that, depended upon whether you're measuring from the breakout there in 1980 or if you're actually going to the actual bear market lows back in 1974 and then taking that up to the top there in 1999 2000, you have this period in time where you were up from 1974 through 2000, or even 1980 through 2000. So you're talking about like 20 to 26 years,
Yep.
right? Which is a significant period in time. So that entire period in time, that was your secular bull market. Now, during that period in time, we also had cyclical bear markets. Of course, you had the crash in 1987, which looks like nothing now.
Right.
But at the time, that was a really big deal. You had the slowdown there in the early 80s. You had 1995. You had the Asian financial crisis, and what was it? Long-term capital management that collapsed. So there was definitely those periods in time where the market had experienced some trials and tribulations there, but it just kept recovering. It just kept going up. And so, in taking a look at where we are here today, going from, and I'm just going to measure here from the lows in 1974, but the lows here in 2009, if we were to extrapolate this 311 bars, that puts us here into
2035. Well, Bitcoin will be over $1 million, so I don't care.
I mean, but this is the type of long-term forecasting sometimes that I think is necessary. And the other part too is that just even doing like simple trend analysis, right? And everybody I think is a little bit different. My personal preference, I don't go to the actual low, I go to the low of the lowest closing candle. And when you take a look at just these trends here, I mean, they're still very much intact. And the frightening thing here to me, I think, is just seeing acceleration, right? Because it's the acceleration, and this is going back to what you were talking about before. It's the acceleration that really kind of is that canary in the coal mine. Because even coming back down here into the lows of 1974, that was pretty steady, right? And then you had the 1980s that happened. And then, of course, you have the 90s here. And you could just go through and take a look at how steep those moves actually ended up getting. Yeah. It wasn't parabolic, per se, like we've seen in some individual stock names. But, once those trends break, though, that is going to lead to more of a secular bear market. And those secular bear markets, this one lasted for 13 years. I mean, going to the absolute low, it was only 9 years, but to the point to where it actually broke out again and started making higher highs, it was a 13-year process. And this back here from 1968 to 1980, that was 12 years. Yeah. So it's a pretty interesting situation that we're in right now. I mean, this is from a bullish perspective, from a long-term investment management perspective, this is great news.
Great news,
right?
Fantastic news, yeah.
Because you have potentially another 10 years of a secular bull market, and you can have a significant amount of growth that actually takes place during that period in time. The thing that you have to be cautious of, though, is that when you see the cracks form, you're going to have to take defensive actions, because the last thing you want to do is just kind of fall into that trap of, oh, well, it's going to come back. Right. Well, it took over 13 years for this thing to come back.
Yeah.
Right?
13 years of opportunity cost gone. And, this is, we talk about market timing a lot and kind of the importance of it. And people say you can't time the markets. But I think in your analysis that you've got on here, it does speak volumes to there are patterns that start to form. We can see trajectory, acceleration, and understand that those lines he's drawn, and there aren't just little squiggly things just for fun. Those represent emotion. Those represent behavior and I guess overall sentiment in the market. And it's just getting more and more bullish. And based off what we saw between 1975 and 2000, you had 3 phases of escalation, and we're just in the middle of our second phase of escalation here. And it's kind of what I was pointing out. Like, if we have this preferential treatment for Nvidia and Apple and Microsoft internationally, and they're the leaders, there's no reason why they shouldn't see more of a positive spike to the upside and further acceleration.
To kind of take it back to your original question, from a national security perspective, personally, I think that they should be incentivized to actually build plants here inside of the United States, and to make sure that they do have access to the minerals and materials necessary in order to actually manufacture those things.
Yeah, we had a comment earlier talking about how they are building plants, and TSM has one in, I think it was Phoenix or in Arizona somewhere, that's got, I think it was 3,000 employees, and they're moving, right? They're trying to get them built as quickly as possible, but these things are not.
It takes time.
Yeah, these are not like, just click a button and you've got a whole facility that's going to be,
You're not building a McDonald's. So, or Chick-fil-A or whatever other fast food chain you like.
You could probably have that up and running in under a year from ground to operational, not these semiconductor companies.
Right, because once they actually have the building built, you've got to make sure that you've got the machines that are actually built. I don't know how long it takes to actually build a machine that builds chips, but I'm sure it's not the same as building a car.
Yeah, it will definitely take some time.
Yeah.
Oh, very interesting. Look, I don't want to. We could spend hours here. I'm going to real quickly shift.
Right.
I'm going to pivot over here, and we've been watching this 10-year. Now, I've been very bullish on the 10-year. I thought we were going to see yields getting much higher, and I'm really surprised to see, especially since mid-May, that we're watching kind of lower lows and lower highs here on that 10-year. And I'm just curious what your take is on it. Is there anything of that's catching your eye?
So, I'm glad you asked because. Part of the B.E.C.C report is bonds. Like that's the first letter in that acronym.
I know.
Right?
We went out of order today. Sorry. I was just starting off with just random questions. But I love how things flow. We're out of order today. We're gonna have to come up with a new acronym.
I'm gonna bring up the 10-year yield here, and it's a CFD data, so take it for what it is. And I'm going to plot this out twice because basically we can invert the scale on this and make it look like bonds because, as most people probably know, there's an inverse relationship between yields and bond prices, right? So let's put the bond prices underneath here, and I'm going to invert the scale so that it actually looks like the bond market. Okay, and just to reinforce that, we'll throw on the chart of the ZN. And the reason why I'm doing this is because the ZN itself has limited historical information, right? That only goes back to 1999, 2000 here on TradingView. But ultimately, going back to the conversation of the difference between, or not the difference, but the types of markets, you have your secular bull and bear markets. We have, and this is something that I think is going to be a bigger factor in how the markets behave, let's say over the course of the next 10 years. Because what has happened here is that we have basically exited a secular bull market for bonds and a secular bear market for interest rates. And to your point, right, I would have expected interest rates to be much higher versus where they are right now. Mm-hmm. Everything seems to have topped out back in October 2023. And, since then, we've just been in this ridiculous range between 3.7 to 4.9%. Now, considering where our national debt is, that's probably a good thing. Yeah. Right. And I would think, and you don't really, I don't hear much of this. I haven't seen it in the headlines. Maybe I'm not digging far enough, but everybody is up in arms on Capitol Hill about the Fed not cutting interest rates sooner. They need to do more. It's like, yeah, that would help, but the fact that interest rates actually aren't higher than where they are right now is actually really good. I mean, they've been steady here almost for the past 2 years, right? Yep. They're not climbing despite our national debt climbing even more. So, be thankful. Yeah. Because the scary thing is this, right? When you take a look at where this major kind of bull market and interest rates broke down, that was in and around this area of 10%. Imagine getting in this case, imagine interest rates back at 10%, right? Now, if you're buying bonds, it's great. I mean, it's 10% yield for riskless investment, right? And I put riskless in air quotes because the higher that goes, the higher the probability of a default. But as it stands, that would have a significant impact on credit. Right. For us. And the fact of the matter is that 70% of our economy is based on consumer spending, and not a lot of people just have the cash laying around to go out and make a lot of really big purchase items. A majority of it is done through credit, whether it's real estate, cars, boats,
Yeah.
recreational vehicles, whatever.
No,
right?
even just credit card debt,
Yeah, and that's credit cards, large ticket items, doesn't matter. Majority of it is being financed. So for now we're okay. It would be nice to see that this actually tops out where it is, but I don't see that happening anytime soon.
Okay.
And when I say top out, I mean like actually breaking down below that 3.73%. But if you crack that 4.91%, I think that is going to be a bigger catalyst for the next bear market, because it would be representative of a lack of demand for U.S.
Right.
bonds and investments, and I think that would dovetail more with the tariff situation than anything else.
At what point do you feel that turns the market sour? So you've got 4.91 mapped out there as kind of the high level we've been in for the past couple of years. Is it a 5% threshold, or do you think it's like, okay, well, 5% is fine, but hey, if we get to 6% or 7%, is there a number kind of in your head where you say, okay, this is the oh shit moment, where it's like, oh no, this is bad?
I mean, personally, I think it's probably going to be closer to 7 or 8%. That would really grab a lot of eyes.
Okay, so we've got a long way to go till we get there.
We do, but it wouldn't take long. It's like when you consider how long it took to go from 1.2% to even just this area here, and that was back in 2022.
Yeah.
That's 2.92%. So we're talking about a double there in terms of interest rates. But even just having a similar increase in a relative period in time, I mean that's this is a monthly chart, so that's within 10 months.
Yep.
That increase actually happened, and then of course from here that was another 15 months. So I know 10 and 15 months sounds long, especially if you're a shorter term trader, for those that are listening, but in the scope of broader macroeconomic analysis, it's nothing.
Yeah.
Blink of an eye.
We're getting long in the tooth here, but let me ask you one more thing here. So obviously a big impact on this is going to be the dollar index, the Dixie, and we have a new appointee to the Fed, Stephen Moran, who definitely says he wants a weaker dollar. You have Scott Bessent, Secretary of the Treasury, says, I want a weaker dollar. So knowing that there's this interest, as well as President Trump says he wants a weaker dollar, how does that play into your analysis, knowing that three big players that drive kind of the economy are thinking that they want a weaker dollar? Obviously, the weaker that dollar goes, the more likely those yields are going to drop, correct?
Not necessarily. You would expect that, right? So when we take a look at it historically, and again, this is only going back to 1986. So unfortunately, I don't have the data to come back here and look at, what the dollar index looked like between 1963 and 1984 with you. But I will say that historically, Republican administrations do tend to have weaker dollars. The one exception was Trump's first administration, but so far for the second administration, that was the top. I mean, if you look at when this topped out, that was January of 2022, and then here's your next one. It's January 2025. This is a monthly chart. If you break it down to a weekly chart, there is the week of inauguration.
Yeah,
literally, right? Now and this actually goes back to what I was saying a moment ago. A lot of this is going to come down to international investment here in the United States. So if we continue down the path that we are right now in terms of tariffs, and other nations decide that, I don't need to do trade as much as what I did before with the US. They're not a good partner for us. I have been able to find other trading partners in other nations. Therefore, if I'm not buying your goods, I don't need to transact in dollars. I don't need to transact in dollars. I don't need to buy your treasuries. I don't need to buy the dollar. The dollar will go down. And yes, it will make our goods more affordable to foreign purchasers. But personally, I would prefer more of a stable dollar than anything else.
I think we all would. It's the ultimate form of manipulation. And as a citizen, you've got to be upset hearing that because you're basically purposely squashing my global purchasing power. You're dropping the value of the money I hold, which is why I'm owning Bitcoin, because you ain't squashing that.
Right, and that's the next point is that I'm talking about it from an international perspective, but from a domestic perspective, you want to talk about inflation, right? Your purchasing power has declined since the beginning of the year by 11%.
Yeah.
Right. So even if the products that you buy are the same price as what they were in January, your ability to buy as much is just not there anymore. So it's still inflationary. So, we should prefer as a society a more stable dollar.
It's funny because
even a rising dollar.
I think one of the humorous things is you hear people like, "Hey, this year's been great. I'm up. S&P's up like over 8%, 8.6% or something like that. Yeah, that's great. But you realize that your purchasing power has dropped by 11%, which means you're a net negative delta of 3% for the year.
Yeah,
that's not a good thing.
No, it's not. So, and this is why you have to look at this information and leave political biases out of everything, because and this is part of the reason why I like the business that I'm in. These are like data points that are etched in stone right now. The factors that are driving these things, they're all going to change from one year to the next. But, if you took the time to become a little bit more informed, you can see through the BS that comes out of any politician's mouth.
Totally. Yeah.
So,
what's your teaching schedule look like? I'll actually bring up your calendar here so I can show you. I know you got tons of stuff going on. You're always busy doing things.
I don't teach anymore.
What? Well, you do the GPS sessions.
So I do. Yeah. So every Monday, Wednesday, Friday, I do the GPS sessions. So I'll just since I'm sharing my screen here, I'll bring it up. But here, Monday, Wednesday, Friday.
I've actually had the calendar up too.
Okay. So students can find me Monday, Wednesday, Fridays, early in the morning, 7:50 a.m. Eastern. During that time, basically what I do is take them through the daily market overview. On Mondays, I also do a weekly market overview. So I incorporate the analysis of the asset class and sector ETFs so that we can kind of get that up to date, week to week, up to date. And then generally it's the first Wednesday of the month. I'll also do General XLT where they call it the monthly market overview. It's an abridged version of the B.E.C.C report. Now the first month of the quarter, I've committed to doing a full B.E.C.C report.
Nice.
So they only schedule an hour and a half, but when I do the full B.E.C.C report, it takes me a good 3 to 3.5 hours sometimes to actually deliver the entire thing. Yeah, it's a haul. And then of course on Mondays, with the exception of holidays, I host the stock XLT. So those are generally the places where students can find me.
I would call that teaching. You said you don't teach anymore. I would call that teaching.
Yeah, I don't travel. I don't stand up in the classroom like I used to. I haven't done that since 2019. So.
Man, why don't you get you back on the road? You don't like teaching?
I like the travel,
yeah.
Right? It is fun, and I enjoy meeting people, but I also enjoy being at home and
sleeping in your own bed,
smoking barbecue.
Yeah, absolutely. No, I'm mad at you. I get it. I understand. Well, all right, man. Well, hey, thank you for coming on. I appreciate it. I'm going to try to. I'm going to bug you a little bit more so we can do it more frequently because I think a lot of it's really, this is just kind of big picture thinking, which obviously is going to be significant for everybody that's watching this program. So I appreciate you taking the time, and I look forward to having you on again soon, my friend.
All right. Have a great day.
Thanks, you too. Guys, that was Scott McCormick giving you the B.E.C.C report. Not the B.E.C.C report. We didn't do the whole B.E.C.C report. We just did a slight little. A couple bites of each one of those. I spent a lot of time on the equity side of things, which I think was fantastic. There's a lot of really good stuff there, especially when you look at the rate of change and acceleration in our markets right now. I mean, it does speak volumes to a more bullish market going forward. So let me real quickly wrap up here for today because I got a whole bunch of things I need to do outside of this show. And that's right. Lisa says, hit the like button. Absolutely. If you're here and you like that, hit the like. I mean, come on. That guy's a CMT. He's brilliant. Scott is one of my favorite people to have on the program. He is always a wealth of knowledge. And even though I may have a perception of the way that something's looking or shaping up, sometimes his comments give me a little bit of extra clarity to a picture that I may be trying to draw for myself. So let's talk about our CPI numbers, which came out today. Expectations were we're going to get 0.2%, so a decline of 0.1 on the CPI. We came out at 0.2 overall. Pretty darn good, and I think the market's kind of rejoiced on that one a little bit today. That does add further fuel to the thought that we are going to have a 25 basis point cut at the middle of September. So that's great. And you notice here, the expectations were that year-over-year change for inflation was going to jump up to 2.8%. It stayed at 2.7 because of that drawdown. So that's a good sign there as well. Ideally, we'd like to see this just traverse sideways, maybe even slowly drift lower. But all in all, this does speak volumes to the Fed kind of having a little more room here to cut rates. And I'll bring up the probability thing here real quick. Let me bring up the CME countdown page and show you what that looks like for the September 18th or September 17th meeting. It's now shifted to 93%. So pretty much a foregone conclusion that we're going to see a rate cut in September on the 17th. Remember, we still have a core PCE price index number coming out, and we also have PPI number coming out on Thursday. So that's your important data there. Now, on the earnings front, I didn't even think I have my earnings calendar up and ready, so I will bring that one up for you, and then we'll take a peek at what's happening for mañana from the economic perspective. There were a couple decent names today that reported earnings, and there they are for you. Oh, by market cap, we start things off with CoreWeave. CoreWeave missed earnings, was down 9.92%. You also had 10 Cent Media. Those are kind of the big ones. And Circle beat earnings by a wide margin. I'm really surprised that it beat earnings by that much. They expected 29 cents, came out $1.02. Was only up 1.27%. Gotta love that. Yeah, CoreWeave's earnings not so good. Now, as far as tomorrow's earnings calendar goes, I'll show you what's cooking there. Again, you do have a couple big names like Cisco. You also have, that's pretty much it. Cisco is probably the only big name for tomorrow, so I'll leave it at that. From your economic calendar perspective, it's quieter tomorrow because we don't have the PPI numbers. That's on Thursday. Here you have, for the U.S., mainly members of the FOMC speaking. Now, this will be interesting to see what their thoughts are. You have Bostic, Goolsbee, and Barkin speaking tomorrow to see what their thoughts are on interest rates, the economy, et cetera, and what their thoughts may be at the next meeting. But it really does feel like a foregone conclusion. We're going to get a rate cut in September. You also have crude oil inventories coming out tomorrow, which will be important. Crude oil was down 1.2% today, still toying with that lower demand zone. Again, I did not pull the trigger. I've been busy pretty much all day, but I did look at crude oil again. I'm on the fence. I'm toying with it to sell some puts here on USO and capitalize on this lower demand level, but I'm just not that confident that we're going to hold. I think we're actually going to break down below this one and head lower on crude oil going forward. That was your worst performer on the day. You also had the dollar index, which we looked at earlier, down 0.43%, but still respecting that trend line we've got drawn there, so that is good. On your gold, well, a little bit of a pause after that significant sell-off yesterday. It was only down 0.17%, still at 3,399. Into positive territory we go. We already looked at the 10-year yield, so I won't dive anything into this. There's really nothing of interest here with today's price action other than its range. For Bitcoin, good news, we started to see things move back to the upside today, 0.58%. 120,155 was the closing price, at least for the future side of things. Good, because that was a monstrous shooting star that formed yesterday. That had me a little bit worried. I thought we were going to see a big down day today, but lo and behold, the buying comes back in and pushes this higher. Our podium is all indexes. A clean sweep from the S&P up 1.07%. You have an all-time closing high for the S&P. Love it. Absolutely fantastic. 6,478, and momentum looks like it's going to keep on going. NASDAQ was up 1.27%, all-time high, all-time intraday high, all-time closing high, 23,938, but that was not the Big Daddy. Big Daddy was the Russell. Remember, the Russell's been way off its all-time high. Still a long way to go until it gets back up to those levels right around 2,477. Today, man, almost 3% move for the Russell. 2,291 is where it was at today. So that was pretty fantastic. And I'm going to leave it at that. Now, I showed some materials. I'm going to do since I had like 3 questions that came in on chart patterns, I'm going to do a little bit on chart patterns tomorrow. I also saw questions about Ethereum. So let me address Ethereum tomorrow, what's going on with that. If you guys are in Trading Academy's Mastermind Program or XLTs, I will be doing the XLT general session tomorrow. At least that's what's on my schedule. And I'm going to do quite a bit on Ethereum and what's going on with Ethereum there. So we're not back to 1 hour show yet. We're going to end it right now so I don't have to get there. But I hope you guys enjoyed that show. If you liked it, give me a little thumbs up or like button or whatever. Scott McCormick, always great for coming on. I appreciate him. And if you have anything you'd like me to discuss on upcoming shows, email me. See it on the screen there, tradermerlin@gmail.com. Tony, good to see you as well. You guys want to hear a cool album? Tony Denzel has a new album out. You can check him out as well. It's pretty cool. XLT tomorrow, I believe, is 10 a.m. Let me check my calendar real quick so we have that one out of the way and I don't mess up. But tomorrow, XLT general session is 10:30. So it goes from 10:30 to noon tomorrow. So there you guys go. Thanks, everybody. Have a fantastic remainder of your day, and I will see you mañana. Take care.